across the world, welcome to a conversation on the financial and capital market as it relates to the economy. Today we're looking at the commodities market and developments there, and let's give you a lineup of some of the things we'll be looking at. The Nigerian Export Promotion Council and 22 non-oil products to be exported. Review of the FX Commodity Exchange Index previous week performance. And we bring you updates on the gold and silver, the precious metals, what's been happening in that space. Let's begin with the recent development that the Nigeria Export Promotion Council has disclosed its plans to drive the focus of the federal government in identifying 22 non-oil strategic products that will be exported to diversify the nation's foreign exchange earnings away from oil. According to the Executive Director of the NEPC, Mr. Olusegun Awolowo, this initiative is part of the Zero Oil Plan currently being implemented by the NEPC in collaboration with the private sector and is estimated to be worth over $150 billion in annual export value at full capacity. Some of the targeted products include palm oil, cashew, cocoa, soya beans, rubber, rice, petrochemical, leather, ginger, cotton and shea butter, tomato, banana and plantain. According to Mr. Olusegun Awolowo, they regard this initiative as a welcome development given the recent impact of the downturn in oil prices on the government revenue and foreign exchange earnings of the country. However, they note that the realization of the objective will be highly dependent on the extent to which productivity in the agricultural sector can be improved upon to satisfy domestic consumption and boost exports. They also note that the Central Bank of Nigeria in recent years, through initiatives such as the Anchor Borrowers Program, Commercial Agricultural Credit Scheme, has played an active role in providing affordable finance to improve the productivity of the agri sector. Furthermore, the Central Bank of Nigeria has also complemented its efforts with the use of administrative controls to strengthen local production by placing a ban on access to FX for importers of many of the agricultural products identified by NEPC. Despite the actions of CBN, growth in the sector is yet to show a remarkable improvement as expected. And based on data obtained from the National Bureau of Statistics, the agricultural sector grew by an average of 3.2% between 2015 and 2019, which pales in comparison to the prior 5 years of 2010 to 2014 and 10 years of 2005 to 2014, when the sector grew by 4.5% and 5.7% respectively. Without downplaying the role of affordable finance in incentivizing local farmers and boosting local production, they believe poor farming practices and inadequate agricultural infrastructure remains a huge constraint on productivity. Majority of local farmers cultivate on small lands, adopt crude implements and methods, and are heavily reliant on rain to grow their crops. These have resulted in lower yields on farmlands. In addition, lack of storage and agro-processing facilities and decrepit road infrastructure which hampers routes to markets have contributed to post-harvest losses, which remains one of the huge adverse impacts on the economy. It can be recalled the last published agriculture promotion document by the former Minister of Agriculture, Alhaji Audu Ogbe, put harvest losses rates of perishable crops at 60%. Boosting agricultural productivity requires increased investment in research and development on plant breeding and crop planting, provision of fertilizers and irrigation facilities, agglomeration of smallholder farmers into larger groups, and enhancing infrastructure, particularly storage and transportation, to reduce post-harvest losses. It becomes even more important to focus on implementing these measures in order to improve agriculture, as the African Continental Free Trade Agreement presents a significant opportunity for the nation to improve export of agricultural produce. That's a laudable idea, and if the federal government can drive that, working with NEPC, we could see Nigeria gaining that $150 billion annual value from exports, which is very much needed now for the country. Previous week, the FX Commodities Composite experienced a decline, closing at 250.08 points in the week under review. This indicated a second consecutive week of decline in the index for the month of August. The index dropped by 4.9% as a result of a negative market performance of maize and soybean sub-indices as against previous week performance in the week under review. Maize and soybean dropped by 7.59% and 1.67% to close the trading week at 159,401 naira per metric ton and 137,270 naira per metric ton, while paddy rice had a positive performance, rising by 3.28% in the week under review, closing at 199,121 naira. With warehouse clearing up storage space in anticipation of new harvest and farmers preparing for next harvest season, the volume of executed trade on the exchange decreased at the period. Low trade volume is often as a result of waiting periods between commodities cultivation and harvest. On the exchange, maize and soybean dropped by 7.59% and 1.67% to close the trading week at 159,401 naira per metric ton and 808,1376, 670 per metric ton. Paddy rice had a positive performance, rising by 3.28% in the week under review, closing at 199,121 naira. Sorghum, soybean, ginger, and cocoa remain unchanged for the week under review. In the open market, sorghum dropped slightly, while cocoa and ginger maintained their prices, while other commodities experienced an uptick in their activities. The aggregate volume of trades executed on the exchange in the week under review totaled 88.4 million metric tons, with paddy rice and ginger accounting for 82.4% and 13.6% of the traded volume, respectively. That's a review of what happened last week on the FX Commodities Index. Let's move on to an interesting analysis from ProShare, Nigeria's leading financial information hub, on gold prices and silver. What's happening there? As you all know, gold had become a very precious source of value in terms of investors looking at it, considering the challenges of the US dollar. But what's happening there now? Let's get this insight. Gold prices have had a stellar performance so far in 2020, hitting a record high of over 2,000 per ounce during the first week of August, $2,000 per ounce. This rally took a hit during the second week as prices of the precious metals tumbled below $2,000 per ounce to $1,911.89 per ounce. On Tuesday, there was a rebound of plus 4.74% as the spot price closed at $2,002.44. That's $2,002.44 per ounce. This rise in price was short-lived as the price declined by minus 3.67% to close at $1,928.98 per ounce previous week, Wednesday. As dollar jumped and Treasury yields gained after the U.S. Federal Reserve's July meeting minutes showed policymakers expressing little support for keeping bond yields. Last week, Thursday, gold prices rose by plus 0.95% to close at $1,947.26 per ounce. Seemingly, it looks like silver is now becoming the new gold. How? Silver has shown stellar performance in the last 2 weeks as demand has gone on an uptick. The metal has outperformed gold as a hidden value investment opportunity. Year-to-date and week-to-date growth in the value of silver has outstripped growth in the value of gold. Silver recorded a year-to-date and week-to-date increase of plus 52.65% and plus 3.03% respectively. The sizzling run by silver in the past few months could be attributed to the recovery in industrial operations as silver is used in electronic parts and the production of solar panels. Another reason for the rise in the value of silver is the depreciation of the US dollar against the currencies of the United States of America's trading partners, rising domestic US inflation, and the collapse in real interest rates pushing investors towards the bullion. Volatility is another factor. The silver market is more volatile than the gold market. For investors looking to profit from a sudden increase in prices, silver's additional volatility is advantageous because more volatility means larger spikes in the commodity's price and stronger potential investor returns. The outlook shows a dash of uncertainty. The bullion thrives better in uncertainty, yes. The global economy is slowly picking up with industrial activities kicking back into action, which has been good for silver but not so pleasant for gold, as the yellow brick has minimal industrial applications. From a market point of view, gold and silver are poised to rise in market value as the global economy takes advantage of the splash of cash coming from quantitative easing in virtually all major global economies as governments try to stimulate their economies against the lockdowns prompted by coronavirus pandemic in first quarter and second quarter 2020. Analysts note that periods of volatility and pullbacks in gold and silver prices will occur during periods of strong risk appetite, which could possibly be pushed by positive developments regarding the coronavirus vaccine and more favorable prices in other asset classes. That just shows you how gold and silver continue to experience some levels of volatility, and instability is a major thing. So the market is continuing to look at developments there, and investors should continue to learn. And where can you learn more than logging on to www.prochange.ng.com to get more insights around developments in the precious metals space. Speaking about the commodities market, a lot is happening this period, and we'll continue to bring you those updates every Thursday on the market review developments. But one very important thing is the need for transportation and storage facilities to be strengthened in the country. This will help routes to markets and improve the logistics for moving farm produce to the places of delivery. Over the years, Nigeria has recorded huge amount of losses in terms of billions of naira due to the inability to achieve effective transportation and storage of farm produce. This has called for the need for more investment in that areas, and we hope that financial services, industry players, banks, investment groups, private equity firms, venture capital firms can partner with major agro companies, and agri-tech companies can also bring out innovation on how we can improve this particular area. Because even in the recent growth rates, it showed that transportation and storage also had a decline in activity. And the pandemic has also brought the need for more innovation in that space, because if we continue to have these post-harvest losses, it diminishes our productivity and the value creation in terms of the market. And that is why the commodities exchange activities becomes very important. And we will be monitoring developments in that space, particularly the plans by the Association of Securities Dealing House of Nigeria, ASHON, their optic on the fact that in third quarter of 2020, we should expect them to roll out the Lagos Commodities Exchange and Futures Market. That would be another innovation and addition to the commodities ecosystem. Indeed, there's a need to strengthen the commodities ecosystem in Nigeria, particularly with the required framework. And I must say here that the Securities and Exchange Commission of Nigeria has been working around that, recently had a forum to look at what can be done to develop that space with all key stakeholders in attendance. And so we hope to see more traction in that regard. We know that FX Commodities Exchange, the private exchange in the country, has been driving effectively, creating value for the markets, but we hope to see other activities fester from there and grow a robust commodities market. Across the globe, we know that the Chicago commodities market remains the big player in the global industry, and there's a lot to learn from that space and how it is providing value to the farmers, to the industrialists, to the investors, and what Nigeria can learn from that. And trust us that in subsequent editions, we will bring some experts also looking at what's happening globally. So globally, it's really a challenging time. The COVID-19 pandemic has brought a lot of disruptions. We've had challenges in terms of driving effectively robust commodities activities, but we know that we'll continue to push for effective advocacy for policies from the federal government, fiscal policies that support agro development and infrastructure, and the necessary investment in technology that can help for storage of facilities and value creation, and also the necessary legislations that are required to support the commodities value chain. For example, the warehousing bill, amongst others, which are still areas that we need to see reforms and implementation and signing of the law. So that will be all for this edition of the Market Review. We'd like you to join us throughout the week to continue this conversation. Tomorrow is Friday, as we wrap up the week on market review. You can send your comments to news@proexchange.com or questions around developments in the capital markets as it respects from commodities to various other segments of the market. We also have our reports and analysis. You can follow us on our website, www.proexchange.com, to watch our videos with our news reports and analysis, and also our Commodities Exchange page. Also this period, we implore our investors and the public to be wary of schemes that are designed to provide 100 to 200% returns to you, but are not registered or regulated by the Securities and Exchange Commission. They are out to rip you of your hard-earned savings, and you don't need to fall prey to that. To come your way again, let's make it happen tomorrow, same time, 10 a.m. Thank you for watching. Have a nice day and stay safe.